All right. So this is Noshi. There are Amy, Chris, Doru, Faye, G, Gail, Gary, George, Gary, Glenn, Hang, Jerry, John, Louis, Manuel, Manohar, Marcelo, Mary, Morris, Nick, Polly, Pete, Rich, Rob, Tim. There Today there are about 28 people. I announced this a little late. I planned it for August 6th, but then today I said, okay, I'll do it. So thank you for coming on a short notice. So today's agenda is we will analyze last week's stock and some of this week's stock, and we will discuss the debit spreads. So let's start. So when we are trading, we try to figure it out how the professionals make money in the stock market, how they come in at the right time, pick up the stocks, and by the time we know that the move has already happened. So they are like from the retailer's point of view, retail traders, they are already ahead, 8-10 bars ahead of the game. So we buy at the top or we sell at the bottom, whereas they are the one who are buying at the bottom. They create the bottom. So we need to figure out how they create the bottom and how they sell at the top. So that's what I study. I've been studying it for the last 10-12 years, and every day I pay attention to it, that this is what they are doing right now. I need to get in. So I will explain to you via some charts, as I do in every webinar. So and in trading, there are many techniques, many patterns, and many studies and thousands of indicators, but we don't have to go through all that. We just focus on few and master those techniques and just keep on repeating. So I do that all the time. If you are part of my any service, you will see I have the same pattern. I just go for it because I know this has worked before and it will work again. So as Bruce Lee said, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So we need to practice one kick 10,000 times and just keep repeating it. And once we master it, we know that this is a money-making machine. So master the techniques which produces high and fast return. So especially in option trading, we need the stock to move fast, so then we can maximize our profit. That's my objective. I'm always trying to figure out how I can go after those trades which are about to move fast. So I'm right, and I'm right quickly. Not I'm right like 2 months. So there are certain strategies. I'm listing some over here, which I follow. So the one I follow is a breakout strategy, and I will show you through some charts when the stocks breaks out or break down, or the breakout reversal where the stocks come down at some support level and then it reverses and makes a breakout kind of move, keeps going after it reversed down. So somebody is sold and they come in and they buy it, and they buy and the stock makes a new high. Opening range breakout is I use it every day when the stocks is moving and makes a new intraday high, breaks out during the day. So any time interval, you can put 5 minutes, 15, half hour, 1 hour, whatever is your time setup, you do. And when the stock is breaking that time limit with the volume, you get in. So I follow this every day. Then these are my favorite: gap up, gap down, gap up reversal, gap down reversal. So usually I like gap down reversal and gap up and the gap up. So gap up and gap down reversal. So when the stock gaps up, it continues making its moves to the upside, or the stock gaps down and it continues going down, or when the stock gaps up and then it reverses. Like today, I think McDonald was doing it. So I was watching McDonald, and there was another stock, which Boeing. Boeing kept going, and McDonald reversed, but it did not reverse enough that I buy puts. So it's like it came down to some support level. So it may go up, where Boeing kept going. So and a gap down and when the stock gaps down and then it reverses to the upside. So this is the fastest, I think, where people make money. They come right at the support and they start buying. Usually the support is 50-day moving average or 200-day moving average. So the stock gaps down right at that moving average and it holds. So if it holds for a while, you can apply your techniques, convert your chart to 5-minute time interval and see if it holds. See where the low of the day is and where the stock is trading. So if the low of the day is closer to your entry, you have less risk and then you get in. So this is the strategy I follow. So I will explain some charts. So I have an offer for $1 for 2 weeks. So if you're not a member of Swing Option, you can try, but it's not for everybody. So if you send me email, then I will send you the PayPal link. So I will only do it if you send me email, and so we are selective. So $1 for first 2 weeks, and then you pay. If you're happy, you continue, but not $1 with regular price. So $1 for first 2 weeks, just for a trial. You see me, I see you. That's kind of thing. Okay, so first chart is the Dollar Tree chart. Dollar Tree, you see it. I drew this line here. It held a 66 level, and since then it's going up. So we are long Dollar Tree. The retailers were beaten down. Now I think they're reversing to the upside. So Dollar Tree, I have a first target at 72. If it breaks 72, see this support, right? So how many times if you draw this horizontal line, how many times it held 72 level? So this is resistance. If it breaks this, then it's going here, 50-day moving average, and this is where I sell, or I don't mind selling it here, 72 level. So this Dollar Tree, and it's doing its side move right now. So any given day, it will just move up, boom. Then it moves up here, 72, 74. I will get out. And this 50-day moving average is declining, so the target is coming down. So 70, the target is now 74. Next is J&J. So this J&J was the earning trade. J&J fell on earning. It fell down here like 130 level, and then it started reversing. So I was watching, I saw the news pre-market, and I had it on my radar screen on TradeStation. So as soon as J&J opens, I was watching what it will do, right? So I mean, it can come down, or so I buy puts if it breaks this level, and I wasn't sure it will go up. But then when I look at it, I saw, hey, it is going up. So when it crossed this level, I bought calls, send the alert to you, right? And I gave the target of somewhere here, 137. So this is basically I did. It pre-market it was down, but when market opened, it just started going up, and I bought calls and I send you the alert. We sold it, I think. Immediately we made money, and then we bought it again. September 140 call. So we did it twice, and this is what happened. So you see, J&J next 2 days kept going. So we locked our gains, and our exit was perfect. Somebody downgraded it, and for 4 days it just kept going down. So now I'm watching it again. So I'm watching J&J for reversal. So if it holds 50-day moving average and starts moving up, we can go long again. So it needs to hold this level. I use TradeStation, Morris. So TradeStation is my broker platform. Yeah, so I'm watching J&J. As soon as I see this support level, if it starts going up, I will jump in. So I just need 132 to cross. It gaps up. Suppose it gaps up here, right, tomorrow or on Friday, whatever. If it gaps up, that's first signal I'll get in. Or boom, 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 white candle like this kind candle. Something happens, some good news, or this, even this kind candle. If it goes up, I'll buy calls. Next is Netflix. So you see Netflix on, this is earning chart. So Netflix gapped up. So if you draw this line, so this is the resistance line, right? All the way. If you connect these dots, I mean these candles. So resistance is this here. And Netflix, I was watching Netflix also during pre-market. It's important to watch the action of the stock in the pre-market and aftermarket if you want to trade that during regular hours. At least you need to have a sense where it was trading. So I was watching Netflix, and then I said, oh man, it gapped up from here. We trade Netflix hardly, I don't recall losing money on Netflix trades. Always make money. So this, when it gapped up, I was watching if it is gonna sell off or not. So as soon as it touched this and then it started reversing, this is the price. At that time, I captured the stock, a chart. I captured the stock, chart when after sending the alert, I just captured it, and we bought the calls. The target now is, this is where people fail. You see, the Netflix is trading in uncharted territory, right? So people say, hey, wow, you figured out the target. Because target, when the stock is trading in where it traveled before, you know where the stock can go, right? It's easy to determine, but it's not easy to determine the target when the stock has not traveled before. So I have some techniques which I use, and I gave the target, and this is what happened in Netflix. We made big money there. I think we made 500 per contract. So this is what Netflix did. There were a lot of buying, and look at the volume. So look here. Sorry. Netflix. Yeah. So look at this bar volume. This is tiny, right? And this is what's happening. So how do you know what it will do? So this is where the experience comes. Volume bar will go up, and this bar will go up. So I'm trying to show you what happened when I entered in the trade and then afterwards. So this is what happened. See the bar, volume bar, how much, right? It was tiny, big bar. So Netflix will go up. It will keep going towards 200. So we got in at the same day because too much gap up from 160.61 to 185. Our target was 187. When it stalled at 184, 185, I took the profit, and the profit was 500 per contract. So it was not bad, right? So Netflix will go up. So I'm just looking for a pullback towards this 180 level on any day. It will happen. Profit taking will come in, and then we get in again. So Netflix is keep going, and Facebook. These are the two stocks. Now this IBM. So IBM, this is the earning. So IBM disappoints every quarter. So this IBM gap up. It was big volume. We bought puts. After we bought puts, it didn't do much that day. It just stayed there. Next day, there was a dead cat bounce, and I received one email from one member saying what's going on when this was happening. So this can happen. This kind of candle usually happen next day. So they try to somebody tries to buy next day, they say, like on the Facebook group, when IBM gap down, they say, okay, so now IBM is down, the yield is looking very good on IBM. So I said, okay, yield will look great when IBM goes down to 144, then the yield on the IBM will be more attractive. So you just wait for 144. And this was our target. We exited today with profit. So you see this day it was moving up with good volume, boom, boom, boom. But you have to hold your horses. Like in the movie, um, Russell Crowe or somebody was saying, or maybe Mel Gibson, when he was a general and other forces were coming in, and he kept on telling his people to hold it, hold it, hold it, and then at the end, at the right time, he said fire. So there's IBM had to go above 150 for us to prove that we are wrong. So it didn't go above, right? So this is a support line. It didn't go above 150. It just died down. Just died down. Time. We call it time fish. So it did like time fish, and then continuously went down. So we exited today. So IBM is like a dead meat. So now it will rest. It won't move much. So there's no use in IBM trading. This kind of chart never fails. This is a TTD trade desk, and I've shown many stocks with the same pattern. So this, when the squeeze is like a squeeze going on, you see, who don't want to trade this candle? And who don't want? You see, the open is at the low. So when the stock made the low and open is the same. So it opened at the price that was the low of the day, and it closed at the high. When I took this screenshot, it was at the high of the day, and high is the close, right? So again, we needed only two bars up, so we traded on earning expectations, and we made money. So this is what TDD did. We exited here, made good profit. So when you see bar like that, you can get in, and this is your stop here. So this area is your stop. This is where it will stall, but it didn't go. So it didn't go come down here, it stayed here, then bounce back up. So I had shares and I had options. Now this is Home Depot. So earlier I have posted the chart on Home Depot, I think when it was doing this, and we traded Lowe's put. So in that webinar, we had Lowe's puts. I was watching Lowe's, not doing much, and it started going down. So I bought puts and I sent the alert. We made money, and I also sent the chart of Home Depot. That Home Depot also looks like going down. And see, so this is the day I sent the chart, and after that it did nothing. It didn't even cross this line, right? And then boom, it came down. So now Home Depot is bearish, but it looks like it is stabilizing. And so the low was the first one, and then the Home Depot followed, and here the Home Depot fell, and then Lowe's also fell, and then we turn around. So we bought puts and made money, and then we turn around and bought Lowe's calls. So I'll explain the Lowe's. So this is what Home Depot is doing now. It looks like it's trying to establish base of 145. So I'm watching it. If it breaks this high around 147.50, I'll buy calls, because now I know that this is my stop here. So if it breaks this 3-4 days candle, I'll buy calls, and this is my stop. And I'll show you Lowe's. So this is what Lowe's did. So we bought puts here, made money, then it held the support, and it came down, came up here, then it just break down. So when it break down like this, I was watching it to see what it will do. It should break. Next day it continues. So if I continues, I buy puts, but it didn't do that. See, look what it did. It gapped up So this huge volume, so it's like a volume climax, and then it gapped up. So it gapped up, I bought the calls. I know my stop is right here. If it breaks this low, I will be out. So why the stock gapped up? There has to be a reason. So it kept going. So I bought calls and alert, and this is what low did. Target was First target was 75, second was 76.40, and you see lows is now stuck in this resistance line. So if it breaks up, it will go up. If it breaks this line, it will go up. So next day, tomorrow, it may come down or just break it. So if it breaks it, if lows break it, I will watch Home Depot and see if it is also moving. So both together, and make my decision and buy calls on Home Depot, right? So it's a caveman trading. So it's caveman trading. Lows move up, and if Home Depot also moving up, I buy calls. This is KSU. This is again, I think, earning candle. So KSU gap down. You see gap down to 100 here, support, and then suddenly I saw when the stock on radar screen on TradeStation, when the stock starts moving, I sort it based on net change, and when the stock starts moving up or down, they come up. It's like horse. There are 500 horses in my TradeStation basket. So there are 500 horses running. Out of 500, there are 20 of them come on top, right? They are running the fastest, so they're moving up. Then the horse which was on 20 level suddenly now shows up at number 10. So I say, what's going on? Why it's gaining momentum? So when I saw this, I mean, not even here. I mean, I saw it when it was around 102, 101. I bought calls and sent alert to buy calls, and the target was 106. And this is what it did that day. Boom, boom, boom. So what happened? Somebody sold, somebody came and supported. They liked the price and they kept buying it. So they bought. 106 was target, and we sold. We made money same day. And then you see, that's it. It's done. So this move in the swing is over. So for swing trader, we need the quick move. So we don't sit around. So that's what happened. Moved up, and we are out. This triple L chart I'm showing you, I sent this triple L here somewhere, debit spread trade. I knew it's gonna go up, but it may take time because of all this congestion. So I sent the spread trade. So spread trade is good when your outlook is bullish or bearish, but it's moderate. So you let the trade work, manage it, and we made 110% on this gap up move. Boom. So it did nothing. It just sit around. So if it's not doing anything, our short side is making us money because losing time. But and then we have a long calls also. So we had a long call. So comparison, short calls and long calls, the move was 110%. And we got out on this gap up move. This is SWKS. So we traded SWKS during this period. Now I think there was an earning, so we got out here on this day. Next day it did nothing. Then this is the earning candle. So it dipped below 50-day moving average, and then it came back up. So I said, okay, I need to buy calls. Why? It's common sense that on earning, the stock moves down and then it comes back above 50-day moving average. So the logic says that it's the earnings, whatever the earnings effect was negative, it went away after 1 hour. So SWKS is going up. Today it reached 108 and it pulled back. So my target is somewhere here, 110.11. So I'll get out here. So it's going up. This is DKS, so Dick's Sporting Goods. So all the retailers and Foot Lockers, etc., going down. But look at this candle. So I made the decision again, the same concept. So concept is it gapped down to this. I drew the support line. So I said, okay, it gapped down, and it's so what should I do? I should buy calls or puts. So if you look at this kind of chart, you should say yourself, I will buy calls, not puts. Why would you buy puts? Puts you will buy if it breaks this level. It didn't break, it held on. So I bought calls and I sent the alert. And the next day, um, it did it. So in this type of trade, the stock doesn't move up fast, right? But it will move up. So explain the chart. So and then it pulled back. So this was a chart. It was making this move, and then it boom, 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 it came down and set on this. So it is still good. It did not violate the low of the day of the gap down. So next day it did this, and I think today it did this, right? So it's moving up, and it almost took out the high of the gap. So somewhere here around 38, I will sell and make money. So if you get in at 35, 36, you sell at 38. So this is coming. This move is coming. There won't be any white space. There will be a candle here. You will see. This is Hasbro. We bought the puts for $3 and it went to $4. I did not sell. I gave the target of 105 and it hit and then it broke down. When I took the screenshot, it's 103.78. I was up $100 per contract. I still have it. Now again, the bottom fishers, they are coming in, buy, and it's not doing much right now. So it's stuck. I expect that it will roll over, come down here, somewhere here. This is where I want to sell. So let's see what happens. This is Manpower. So Manpower also gap down on the same day as Hasbro, and it looks like it's coming to 105 somewhere here. So when it comes here, maybe it will get support. So it has room of 4 points. Oh, it touched, yeah, today it touched 105. So because it touched, the reason I'm holding and I bought puts, it touched. It's barely, I mean, it looks like as if it's just holding its nose here. So it's not dwindling a candle like these. So it's a big red candle. So next, if the next move happens, it will break. It will break towards here. So I took my chances. I said, okay, I expect this break. So tomorrow you see, tomorrow or the day after tomorrow, does it break 105 or not? If it breaks, it's coming down here. This is Tesla. We trade Tesla a lot, and when we traded at this level before, always make money. And this is when Tesla was going down, the people saying, oh, bearish, this, that. So I was saying, no, now Tesla has bottom. So bottom, there's a bottom. It topped. I said, yeah, it topped here. Now it bottom here. So I'm long. So I sent alert to buy calls. I had an earning trade, and and debit spread. So the target was 342. So this candle told me to buy. Simple, this candle, and it hit 342 and it crossed. So Tesla, this is the way I decided. It has support at 300 level, and it moved to 342. I think it's trading above 342. So I got out here. Now Goldman Sachs. So Goldman Sachs we trade also, and we always make money. So Goldman Sachs is also favorite. So Goldman Sachs dropped, and this is the hour entry point. So I sent alert and bought calls. So it gapped up. So I said, okay, it gapped up. Financials were moving. So you cannot just make trade decision just by looking at one chart. What other stocks are doing in its category? What is Citi doing? What JPM doing? What AXP doing? What Morgan Stanley doing? What others are doing? If others are doing something like going up, then you choose which stock you want to trade. So I took Goldman Sachs, and my target is somewhere here. And today it went up further, and it pulled back. So it's going up. It's common reason, common sense. This is NEM. This is again, I send this alert on my earning trade service. So NEM was moving up and other gold stocks, so I chose this, and we bought calls for $1.60. We sold it at 230, I think 230, 240, same day. So when it was moving up, doing this action, I said, okay, I'm gonna buy. This is running up for earning. So I bought calls and alert, and we sold the same day. We sold it right here. Target was 37, which it hit today. No, we sold it at 36.50, and target was 37, 37.50, this area. So I took the screenshot here. And today, yeah, so see, this is the high. We sold it at 36.50, same day. So same day, if you are up 40-50%, same day is good money. And then because it can come down, right? Then you are break even, or you're making only 10%. So, but it hit the target today. This is PXD. So I send this alert on my earning trade service. Oils were moving. Oil is moving. Oil again. Another people say, oh, oil is going down, and oil stocks are not worth trading. The first doesn't say never, because if oil is going down, then you can buy puts on oil stocks. If the oil is going up, then buy calls on oil stocks. So never say never. So oil has bottomed on June 21st at $42. So if you look at the crude chart, you will see it's a $42 bottom on June 21st. And the oil stocks should be traded on to the upside. So I bought the calls on PXD, and I sent alert. I'm still holding it. So it's doing, it was up today to 165. It hit 165.50 or something. Then it came back to 163.42. I'm still holding. Okay, so I have another program, which is 6-month coaching program. If you're interested, then you can send me email at noshi@financialmarketwizard.com to book your 40-minute strategy session, and then we talk about it. I will explain what it is. It will start mid-August. I already have my students enrolled. I'm just preparing the course, and I will launch it mid-August. So if you're interested, please send email to me. Okay, and the swing option service, you can try out for $1 for first 2 weeks. Then you pay the regular price. And if you're interested, then please send me email. You have my email address right in front of you. Okay. Next webinar will be on August 6th. And now we discuss the spread trades. So I close this. Here. Here, this one. So I will explain this part of the presentation. I will explain the spreads, and especially vertical bull spread, because this is mainly we trade vertical bull spread or vertical bearish spread. So I explain what it is. Even if you know, maybe you learn something. So in this part of the presentation, you will learn what is a spread, what are the objectives of spread trade, the characteristics of a spread trade, kinds of spread, types of spread, executing vertical bull spread, calculating maximum profit, calculating break-even profit, closing the spread, and type of account needed. So this is what you need and what you will learn. So let's move forward. So what is the spread? The spread is simultaneously buying one option and selling another option with different terms on the same stock. So you buy one, suppose you're putting a bullish trade. So you buy one calls and then you sell another call against it. So when you sell, you get some money. When you get money, your cost is reduced on your long calls. And so you minimize your cost, reduce your cost, but your profit potential is also limited. But limited means it's like 100% gains, or I mean, through my strategy, if you see it, I will explain, you can make like 200%. So that's limited. 200%, 100%. It's common. So the objective of spread trade is to reduce the risk. So how you reduce risk? Because if you buy call on, suppose Amazon, you pay $10, for instance, you can sell a short, you can sell a call against it, suppose for $6. So your net cost is $4. So you are reducing your risk, but you're limiting your profit. The second objective is to lock unrealized gain in existing trade. So let's say you have a, in like Facebook, tomorrow Facebook will cap up trading at 171. Suppose you had a 170 strike. One member sent me email, she said, I have August 165 and August 170 strike. So suppose you have August 170 strike, it gapped up, you're making money, you don't want to sell, get out of all the long calls. You can sell, because Facebook can move up, you can sell 180 strike against your 170 calls. So you get the money, your cost and some gains out of it by selling 180, because 180 strike will give you the money. And now you will maximize the gain. You are in the trade and maximize the gain when Facebook goes to closer to 180 or above 180. So in other words, you took out all your money, profit and the gains, almost all, and then you're still riding in Facebook, just in case it goes to 180. So that's the purpose. Another purpose. Next is, so in this, usually in the spread trade, the outlook is moderately bullish or bearish, because if it's ultra bullish, like stock is moving up, then you will just buy straight calls or straight puts. And the other characteristic is the limited risk. So you are minimizing the risk, but you are minimizing the profit. And the fourth reason is, so there's a limited profit and limited risk. The fourth reason is also that you don't have time to monitor. So that's another thing I need to put. So you don't have time to monitor your trade. So you put a spread trade, and every day you just monitor it for 5 minutes, see what it's doing, and that's it. So you monitor in the morning what happens and 5 minutes before market close, and that's all you need to do. So that's all I do in the spread trade. I just keep it on the side. So they are like cooking on the side. I don't worry about the day-to-day move. I don't even look at the chart. I know that, okay, if I have put on the trade, I know what price I put, what's my target, and it's doing something, it's up $1 or it's down 50 cents or dollar. I know it's just doing its thing. I don't need to, it's a well-behaved child. I don't need to monitor the well-behaved child. When the stock reaches target or does some move, then I just take action, either up or down. So there are two types of trade. You can put bull spread or bear spread. So if you're bullish on the stock, you can put bull spread. If you're bearish on the stock, you can put bear spread. These days I'm just putting bull spread. So there are three types of bull spread and 3 types of bear spread. So the 3 types of bull spreads are called, one is called vertical bull spread, another one is horizontal bull spread, and the third one is diagonal bull spread. So there is a reason for it, and I do mostly vertical bull spread, and this is what I have a service for, vertical bull spread. So I will explain in a minute. So in vertical bull spread, the expiration date is the same. So if you buy, suppose Facebook, August 170, tomorrow, for instance, you can buy September 170 calls on Facebook, right? It's trading at 171. So Facebook eventually will go to 200. That's the target I gave long time ago. So it's headed there. Facebook is going to 200. But let's say you think, okay, Facebook will go to 180. Tomorrow you don't know because of the timing, and you have a problem with understanding the gaps. So you don't want to just worry about it. You know that Facebook will go up. So you buy September 170 calls and you sell against September 180 calls. So that's bull spread. So you have same expiration date, which is September, but the strike price is different. 170 you buy and immediately you sell 180 calls. So you reduce your cost, and your maximum profit will be when Facebook goes to 180. So let's say Facebook goes to 180 by September, and it will. So vertical bull spread will make you money and you don't have to do anything. So this is vertical bull spread. The horizontal bull spread is expiration date is different. So you suppose you buy September 170 calls on Facebook, but you sell August 170 calls. So expiration date for the one you're selling is the shorter term. So you're selling August 180 calls, or some weekly options. So if weekly option is available and expiring, suppose on Friday, you can sell and collect some premium. So, and the strike price is, no, for horizontal, the strike price is same. So what's happening is September 170 calls, suppose you buy September 170 call, and then you sell August 170. So you're collecting the premium, just a little bit. So in the horizontal, you need to buy like 175 calls and then sell August 175 calls, and it 2 days left or 4 days left or 1 week left, and you know that in 1 week Facebook will not go to 175. So if it's not going to 175, nobody will ask you to deliver the stock. So you're safe, and it expires, the short strike expires, and you collect the premium. So when you collect the premium, it's yours, your cost goes down for the long strike. Then you can repeat the same process. Now diagonal bull spread, the expiration date is different and the strike price is different. So in diagonal, you buy September, suppose 170 calls, and you're selling August 180 or 190 calls. So way out of the money you're selling it, and you know the stock will not go there, and the expiry date is very close, like in a week. So that's you collecting some premium to reduce the cost. So that's diagonal bull spread. So you can do that too. So now how we will discuss only vertical bull spread. So we discuss vertical, we discuss diagonal, and we discuss horizontal, and we're discussing the bull side. Same thing you can discuss on the bearish side. So I will only discuss bull spread and vertical. So here is the scenario to explain to you. The scenario is that the stock is XYZ and you're moderately bullish, or you don't have time to monitor. The stock is trading at 101, the target price is 111. So at this time the stock is trading at 101 and you know that it will go to 111. And let's say today is November, so it's the month of November. So what you will do, so if the month is November, you will buy January 100 calls at $5. So let's say the January 100 calls are selling, trading at 5, you buy $5, and your target is 111. So you will do buy to open. So always do this leg first, buy to open. So you buy to open January 100 calls, you paid $5. Then immediately you execute another trade, sell to open January 110 call at $2. So because when you buy, you have this one contract, you can sell one contract against this and you collect a premium of $2. So now your cost is $3. So per contract you're investing, per trade you're investing $300. If you don't do this, then your investment is $500. So you're reducing the cost, bringing the cost down to $300, but your profit will be limited, because when the stock goes up to 111, this strike will gain value, and this January 110 call will gain in value also. But because this is in the money and this is out of the money, so this will gain more value faster relative to this 110 call. So that's the objective. So this is moving faster in value and this one is moving slower in value. So the difference is is your gain. The difference with this $3 will become like $4, $5, depending on how fast it moves. So and how to figure out how much you will make the maximum profit. You take the difference in the strike price and then minus net debit. So the difference in the strike price is this 10 points, right? Because you sold 110 calls and you bought 100 calls. So the strike difference is 10, and then you paid $3. So maximum profit potential is $700. That's 233% gain. So by putting $300, you're making $700. When the stock goes 110 and above by expiry, you stand to gain 233%. But you have to hold till expiry. If you sell before expiry, your percentage gain will be lesser than 233%. And you can always calculate your break-even price. So break-even price is lower strike price plus net debit of the spread. So lower strike is 100, and you paid $3. So your break-even is 103, and the stock is trading at 101. So when this stock goes to 103, you're at break-even. As long as it stays above 103, you don't lose any money. And the maximum you will lose is this net debit spread, which is $300. And the maximum you will gain is $700. So you know how much maximum you can lose, what is your break-even point, how much is maximum you will make. So you know all your boundaries. So then you just monitor it, manage the trade. And your gain, from if you're managing it properly, if you know, if you can read the chart, your gain goes up. And I explain to you how. So for instance, Tesla, right? So Tesla, you buy a Tesla debit spread, like we did. So long calls and short. Then after we bought after we put the spread, Tesla came down. And when Tesla came down, the short strike lost 35% value in it, and the long strike also lost like 20%. So we were losing on both sides, right? I mean, one side was losing and another side gained because of the short strike we sold already. So when Tesla came down at support, I sent the alert to close the short strike. So we closed the short strike, we made 35% gain. So now we are only long on Tesla. With that 35% gain, because we knew this is the support, we bought more long calls. So we doubled down on the long calls. And then when Tesla moved up, we made another like $900 per contract. So the gain can go up if you can manage, if you know the support and resistance level. Your gain can go higher, be higher. So these are the points you need to consider. The first trade is always buy to open. So you always buy to open first, and then you execute sell to open. If you try to do sell to open, then you will, if you don't have that level of clearance, you will not be able to. You will get error message because you're not selling anything you don't have. It will be naked calls. So if you have the level, you level 5 or something, you can sell it, but not advisable to do the sell to open. You have to do buy to open first, and then you do sell to open, or you execute it as a basket. So on your brokerage platform, you can specify as a basket, and you can specify the basket price of $3. So you say, okay, I will pay the net debit of $3. So you know, so between ask and bid, and the ask and bid of the short side, you just your broker is executing it, and you're getting the price in between the ask and bid, and you don't want to pay more than 3. So you just specify that, and trade will be executed as a basket. So you can do that, but I don't do that. I just follow this buy to open. I know that, and then I sell to open. Immediately after that, I specify the price. I don't sit around and say, okay, let me now see if I can reduce, if I can get some more price. I don't do that. if I'm putting on a debit spread trade, I take care of it right away. So the first step is, when you're closing the vertical bull spread, first step is that you need to close the short strike. So you sold to open January 110 call, you have to buy, you have to execute this trade, buy to close. The brokers have this button for you. In TradeStation, they have button, buy to open, sell to open, buy to close, sell to close. So they have these 4 buttons specifically. They made it very easy. So on your brokers, just figure it out. The button or the order, drop down somewhere, buy to close. So you close this, so you don't have any short strike in your portfolio. Then you can sell to close your long strike. So let's say the January 110 trading at $6, right? So because the stock moved up, so you sell at $6, you buy at $6. Then immediately the second step is close the long strike. So January 100 calls is trading at $12, so 100 gain more. So your net profit is $6. So net proceed is, you paid $3, you gain $6, your gain is 100%. So you put $3, you made $3, your gain is 100%. And when you put this trade, you're doing nothing. It's 5 minutes it takes to execute the trade. So what not to do in vertical spread? The spread order should be executed as a basket. So this is what you need to do. What to do in vertical spread? Spread order should be executed as basket. So you need to execute both legs simultaneously, and both legs, usually both legs should be closed simultaneously. That's the objective. But if you're an active trader, you can close the short leg when the stock goes down at support and you have a bullish trade, and then double down on the long side, and it reverses up, you make money on that. So you can do that too, and I do that, and I send the alert to do that. So next is, the type of account you need for spread trade is the margin account. So you cannot do in cash account. Ask your broker what is the minimum equity requirement, what is the maintenance requirement, and it varies from broker to broker. So you have to ask your broker what is the minimum equity requirement, like $2,000 or $5,000, and you need a margin account because of the short strike. And how you can maximize the vertical bull spread gain. So this is the way I do it. So if you support, you put on a Tesla trade, right? So Tesla is supposed trading at 305 or suppose 310. The target is 342. So target is 342, trading at 310. Let's take a Facebook trade for tomorrow. So let's assume Facebook is right now is 171, right? So tomorrow, we don't know, it can come to 165 or it can go to 175. So let's say you figured out the support is 165, and you know Facebook can go to 175, 180, or maybe it goes to 200 by September, October. So you know all this. Once you know this, you put on the spread trade. September, let's say you buy September 170 calls and you sell September 180. So your cost $4 or $5. Now you know Facebook support is 165. I'm giving you right now. So it's 165. Let's say after you put on the trade, Facebook, after 3-4 days, for 2-3 days it goes to 174, 175, and you're still holding your spread trade. But then something happened, bad news, whatever, it came down, and it came down to 170 or 168, 165. So if it comes down to 168, 165, your short leg will be losing money and your long leg will be losing money too. But your short leg will be losing more money because it's out of the money calls, 180. So 180 strike will be almost at 165, it will be like 10 cents, 20 cents. So this is another logic I do. I automatically place the close order at 20 cents. In case something happens, the short strike is trading at 20 cents, I'm already out. So I place the order buy to close at 20 cents, because the option can go down to zero value, right? So if it's already trading at 20 cents, I don't care about another 20 cents, and I close it. So you can put Facebook, suppose you will buy your short strike, buy back at 20 cents. So at 165, Facebook is trading at 165, suppose from 2 weeks from now. Your short strike, suppose you sold for $4, is trading at $1, and 165 is the strike. 165 is the support. So you buy it back. So when you buy it back, you made $3. Now you don't do anything with the long calls, the long strike you have for 170. You wait, and then when you see the turnaround, you double down on the long strike from the proceed you had from the short strike, the gain. And then on the way up towards 170, 171, you get out. So you made money overall. So this is one thing you can do, knowing the support, knowing the resistance, knowing your target. You close your short leg at support. So suppose if it goes down, you close and it's a support. So you don't want to hold the short leg, you can close it. You can then on a turnaround, you can double down on your long side. And not only that, you can buy on a spread trade. Suppose Facebook, you execute spread trade tomorrow. You can buy additional calls, September 170 calls or September 175 calls, and you sell that for quick profit. So you can have additional long calls in your portfolio. You can have shares. You can buy shares on the run up. And I will give you one example we did for Genie. So you can do all these techniques if you're an active trader. If you're not an active trader, you just put the spread trade. It takes 5 minutes and that's it. You just watch it and then close later. So I will explain what we did in Genie trade about a month or 2 months ago. So vertical spread and aggressiveness. Now, there are 3 types of vertical spread. So conservative spread, aggressive spread, extremely aggressive spread. I do aggressive spread, and this is what I send alert. Aggressive. Conservative spread is when you are buying and selling both calls, short and long, are in the money. Aggressive is your long calls are in the money or at the money, and out of the calls are out of the money. So that's aggressive. And extremely aggressive is your long calls are out of the money, and then the short calls are further out of the money. So for instance, for Facebook example I give you for tomorrow. So I give you both 3 examples. So conservative spread, suppose Facebook is trading at 171 tomorrow. So conservative spread is you buy 165 calls and then you sell 1670. So both are in the money, and Facebook is trading at 171. Aggressive spread, which I do, because Facebook is trading at 171, I'll buy 170 strike and I sell 180 strike. So that's aggressive because it's 10-point wide. So the wider the trade is, the more money you can make when the stock goes that strike, the short strike. So Facebook, suppose you buy 170 strike and you sell 180 strike. So 10-point wide trade. So when Facebook goes above 180 by September expiry, you will make 10 points, and whatever is the cost, your cost may be $4 or $3. So you can make 200% gains on aggressive trade. Now, extremely aggressive, where you can make a lot of money, but you can lose all, is suppose Facebook is trading at 171, you buy 175 strike, which is out of the money, and you're selling 180 or 185 strike, which is further out of the money. So both are out of the money. If Facebook goes above 175, you will make money, but if it closes below 175 by expiry, then you lose all. So this extremely aggressive spread is, you have to really know what you're doing and what you expect. So stock has to be bullish, very bullish. So it keeps going up, boom, boom, boom. It is 171, it goes to 175, and then 180. So I go middle of the road strategy, aggressive spread. So vertical spread option service you can try for $17 for the first month. Second month is 57. Price is 77. Valid till Sunday 9 p.m. I have put the link for vertical spread for $17 in the chat box, so you can try that for first month. And this is the Celgene trade. Or you can send me email. If you don't have that link, you can send me email and I will send you the link for both swing and vertical spread. So this is the Celgene trade. We make money on Celgene all the time. So there are certain stocks which you don't have to trade like 500 stocks. You can just trade 50 stocks, top of the line. Just master it. I see people in Facebook, they are chasing penny stock, they are chasing pump and dump, and I'm sure they're losing money and all that, and they don't admit, but they are. All you have to do is master a few stocks, top 100 stocks, liquid options, always in the news. You just trade that. So Celgene was one of the spread trade. I saw this support from here, so I sent the alert. On a pullback, we sold the short leg, and then we doubled down on the long leg, and I also kept saying that, okay, you know, the Celgene is going up, you can buy more calls. So just like long call trade, and we bought it, more calls. I also bought shares, and Celgene was just going up. Biotech stocks were going up, so everything was in line, right? Biotech stocks going up, Celgene is going up, so kept buying long calls and shares, and this is the target was 125, and this is where we sold it. So I think we sold it here 122, but the target was here, this zone, so we sold it here. So the profit can go up more than 100%. What the spread trade is saying, 100% gain is for 5-minute spending time. If you have more than that, you can make a lot of money. So this is Celgene trade. And once again, I have a coaching program, 40-minute strategy session you can have with me. We can talk. You can send me email at noshi@financialmarketwizard.com. And that's all I have. It's almost 1 hour now, 1 hour, 2 minutes. You don't need the certification, Morris. You just need a clear margin account. So if you just call your broker and say, okay, I want to open a margin account. And then you can trade spreads. So a spread trader is very convenient for those who are busy, don't have time, or even if you're busy, you can put it on the side, another service. I have members who are, I have 8 services. I have members who are in all 8 services. So I mean, they are all in all. I have index service, debit spread service, swing light, leap, and end of day worksheet. They are all in all service. My screen up. Which screen you want, Tim? Which screen you want me to put? So this is my screen. This is Celgene trade, and this is vertical spread. $17 for first month, then 57. Price is 77. You can send me email, or I have put it in the chat box. So let me see if I can put it again in the chat box. I can put the link right now, so you can. This is for swing. So swing is like $1. So let me. Sometimes it doesn't do. It's just doing thing. If anyone interested, just send me email and I will send you the link. I have put the link in the chat box. So for David spread. And if you have any questions, then send me email. Okay. So thank you very much. Bye.